Hi traders, you're welcome back once again to the Bullish Bear FX Academy. My name is Tim Legion. I'm super excited having you all here today on this one. So you're welcome back once again to the 2024/2025 trading syllabus. Here in this channel, our goal is to teach you a whole lot you need to know and probably everything you need to know about trading from start to finish till you become a professional in this. And the goal is we want to take you guys step by step until we make sure that you are good in the trading industry. So what you want to do in case it is your first time here is to hit the subscribe button, turn the notification bell on, and please, as a way to show the support and as a way to show that indeed you appreciate our efforts and what we're doing in this channel, make sure to hit the like button. And at the course of the video, if you have any question, please do not hesitate to drop them on the comment section, because based on your question, I will understand where you need more explanation and know how to teach you more even in subsequent videos. All right, so make sure you engage in the comment section. So let's get into the main video. Market structure simply means the structures that market price creates while it's on its movements. Okay, when price is moving, it doesn't just go straight up for bullish, neither does it just go straight down as bearish. It goes in waves. It gives you higher high, higher low, higher high, higher low for the bullish trend. For the bearish trend, it gives you lower low, lower high, lower low, lower high. So we have what we call three phases of the markets. Three phases of the markets. Phase one is known as the bullish trend, which creates higher highs and higher lows. Phase two is known as a range, okay, which goes sideways. It has no definite direction. That is, it's not going high, neither is it coming low. All right. So phase three is known as what? The downtrend, the bearish trend, which is lower lows, lower highs. That's what it creates while it makes its movements. So when price creates this structure, there's every tendency that in the nearest future, these structures can always be revisited again. So that is why you see people win in the forex markets. Why? Because they are using the ideas or the structures that price created in the past. They are using it to judge the future. So that is why it is easy if you know market structure, because if you know it, it's going to be easy for you to predict where price is going. So that's why I told you guys earlier that it is very, very important as a trader that you understand market structure before you begin to trade the markets. So let us begin our training. So when we say market structure and market phases, we have what we call price creates lower lows, right? Okay, this is how price moves, okay, for a downtrend. And here we have what we call the low. We have what we call the lower high. We have the lower low. We have the lower high. We have the lower low. We have the lower high. All right. So this is exactly how a downtrending market moves. From the low, it goes high. Because it's a downtrend, that's why your low, which is the L, would be first, followed by the H, right? So low, lower, high. Beneath becomes lower, low. When it goes higher, the low, the next low turns lower, high again, meaning that these are the highs of the structure. But because the highs are going low, that is why lower would be in front of the high, which is lower, high. lower high, going lower high. Is a high, but it's going lower. I hope you understand it now. Why? This is the low of the structure and it's also going lower. That's why it's called lower low, lower low. Okay, so that is for a downtrend. That is for what? A downtrend. Now, the second phase we have is a range, which goes like this. Everybody must have seen that happen at often times in the markets. It goes sideways, no definite direction at all. But what it gives you is what? A definite high and low, just like that. It's not going higher, it's not going low. But what you just know is that this is the high of this range and this is the low. So for a ranging market, you don't have to do anything in a ranging market to prevent loss of fund in your account, because when the market is ranging, you don't know whether it's going up. You don't know whether it's ready to go down. So if you're trying to force yourself to trade in a ranging market, you are only gambling against the markets, which is not advisable for traders. You're not here to gamble. You're here to trade. So that is why you must obey market structure if you know you want to win. The people who love to trade ranges are scalpers. They just want to buy from oversold and they want to sell from overbought. Okay? They only want to buy from oversold and they want to sell from overbought. And they don't want to waste time. Once they buy the few they can buy, they zoom out of the markets. Okay? They zoom out instantly off the markets. Why? Because they know that the market has no definite direction and anything can happen. So as a trader, I advise you to stay out of a trade when the market is ranging. All my classes, I always advise my students to only trade along with the trend. Okay, so the next phase of the market is what we call an uptrend in markets. We've talked about the downtrend. Now we've talked about the range. Now let us talk about the uptrend. So this is how an uptrend in market moves. Okay, giving you the high, giving you the higher low, giving you the high, giving you the higher low, giving you another high, and higher low. Okay, so because it's an uptrend, that is why you always have the H in front of the L, which is the high in front of the L. Okay, this is the high of the markets. That is why you have it to be high, high. This is the low of the market, but it's going higher. So that is why it's called a higher low of the market, higher low of the market, higher low of the markets. So I believe now you understand the logic behind the reason why people call it higher high, higher low, or low, lower high. Okay, so in an uptrending market, it is advisable that you only look for buying opportunities because you want to trade with the trend. Why do we really trade along with the trend? We trade with the trend because we believe that that is where the higher institutions, the big boys in the market, those who load money into the markets, that is the direction they are going. So we want to go along with them. So that is why we actually trade along with the trend. Okay, so there is no sense in trading against the big boys who are loading money. I always tell people this: we are retail traders. Even though you use 100 standard lot size in trading, you're still a retail trader, and your 100 thousand lot size cannot move a single candle on the charts. We have to understand that the amount of money that flows in and out of the forex market every day is worth 7 point something trillion dollars. 7 point something trillion dollar, or even more. So you can imagine if such amount of money is loaded in the market just to make sure the market is moved, then how much is your little account? So we retail traders, we don't move even a single candlestick. That is why, since you don't have the power to move the candle, you should only do what? Follow those who have the power to move it. When they move up, you move up. When they move down, you do what? You move down. All right. So that is why we say trade with the trend. When the market is trending down, sell. When the market is trending up, do what? Buy. When the market is ranging, don't do anything, because here, those who have the power to move the market have not decided where they want to go. Now, I'll give you a logic of what really happens in the markets that creates the structures. Now, when the market is being bearish, for instance, we using Euro USD. All right. If we know Euro to be what? The base pair. Why? This is the quote, right? If the market is bearish in a Euro USD market, it simply means that, I just want to be sure this thing is recording, okay? If the market is bearish in Euro USD markets, this simply tells us that Euro is weak. Euro is weak, right? And USD is strong. Just understand what I'm going to explain to you right now. If Euro is weak in a market where Euro is the base and price is selling downward in an overall trend, it simply means that Euro is weak in price. Something should have happened that is making Euro to be weak. Maybe the economy is facing some challenges, or maybe there is a change in maybe employment rates or some other things. By the time we start studying news, fundamental analysis, you would understand the things that makes an economy weak or strong to move price when we get there. Okay. So if Euro is weak in a market where you have Euro to be the base and USD to be the quote, it simply means that the market would be going downward. Why is it going down? Because USD is suppressing Euro. That is why it is a fight of the bull, all right, and the bear. Okay, it's a fight of the bull and the bear. So if any currency is weak, the other will have to suppress. So if Euro currency is weak, maybe due to unemployment rate or so, if their economy is weak, okay, there wouldn't be enough money to load into the forex financial markets. Why? Because the economy is weak. When an economy is weak, it simply means that, man, there's no money. Okay, but when an economy is strong, there's enough money. So if Euro is weak, means that something is happening that makes them not to have enough money to load into the financial market to move those candles upward. So if since they are weak, but US dollars is strong, that is why US dollar, because it's strong and the economy is strong and they have enough money to load into the financial market, that is why they continue to suppress Euro. All right, they continue to suppress Euro. So what people would be doing is to be selling off their euros because they want to buy dollars. They are selling off the Euro because I cannot continue to hold Euro and Euro is falling. The more it's falling, I'm holding it. Why? It simply means if I continue to hold this Euro and it's falling, it's continuing to diminish, It simply means I might end up running total loss. Who knows if it's ever going to come back up in this life? That's exactly what happens to the crypto traders. You see a lot of them holding Bitcoin. When Bitcoin is falling, some of them begin to shake and they want to sell off their Bitcoin ASAP because they don't want to have a scenario where it's going to fall and stay forever before it ever comes up. All right. But once you see it's coming back up, you see people making the money, their money begin to increase. So just like that, it happens in the currency market. So when euro is falling, they begin to sell euro, buying dollars. Okay, so that is why, and you see the markets move downward. And when market is bullish in a euro USD, simply means that the euro currency is strong, the economy is strong, maybe employment rate is good, things are working well in the country, all right? Or there's an improvement in their government or whatever, and you see the price continue to go bullish, strong, all right? Now, take note, that does not mean that maybe the US dollar is weak. It could only just mean that the euro, the economy is stronger and they have in more money than the US dollars that when they loaded into the market, it moved the market upward. Okay. Now, when the market is ranging, it does not mean that both the euro and the USD economy are bad. No, it means two things. One, either maybe the amount of money they have loaded into the financial market is currently on an equilibrium. Okay, is currently on an equilibrium, or they just want to manipulate retail traders for a little while. Okay, either it's currently on an equilibrium or they just want to manipulate retail traders at the meantime. And this is when you see a lot of retail traders, because they see price go like this. You understand? They say, oh, it's coming out, let's buy, and it comes back in, hits their stop loss. It comes to this side to take some liquidity from those who think he's selling. They'll say, oh, he's selling, let's buy, and it goes back in. They are taking money from both sides, up and down. USD is taking money, euro is taking money from the retail traders. All right, they're busy swapping money, hitting people's stop losses all around, left and right. All right, so as euro is taken, USD is taken. When they've taken enough, all right, when they've taken enough, then price now begins a real direction, either to the upside. Okay, so this is why it is advisable that you don't trade in a range, because the market is indecisive. There's no definite direction. There's no decision to go anywhere. All they're doing is either manipulating, or the amount of money in the market is on an equilibrium from the base side and from the quote side, that there is no enough strength to push up. Let's say the money from the euro is $5 and the money from the USD is also $5 equilibrium, right? It can push up, it can push down, so it's going straight. So since this is what is happening in the market, this is why they will continue to move up and down, taking people's stop losses out and on and on. What they are doing is they are actually accumulating money. So if the USD ended up grabbing more money than the euro from the upside, the USD will have to be the one to break out and continue, because they have grabbed enough retail traders' money. So imagine those who loaded 2 standard lots, 3 standard lots, 4 standard lots, those who loaded mini lot sizes, those who loaded micro lot sizes, thinking that price is breaking out, and they are busy grabbing these people's stop losses. They are only using it to load their accounts to push price even the more. So for you not to fall prey to those shit, what you need to do as a trader is completely stay off the range. As you are off the range, there are actually people all worldwide who are actually trading in that range. There are people who are risking their hard-earned money in that range. But you, because you have the wisdom and the idea of what's happening, you are off the markets. So let them use other people's money to load themselves and begin the real move. Then we look for entries. I hope I'm communicating. All right. So that is why you should not trade in a range. So you understand why price can slope down in a currency pair, and you also understand why price can slope up in a currency pair. And now you also understand why price really moves in a range, what they are doing in that range. They are not joking. They're not just sitting there. They are grabbing liquidity. They are grabbing money from people's accounts. Okay, so know what to do when you see a range from now onward. Okay, so this is how market structure really moves. Okay, up, down, up, down, up, down, going down, down, giving you a bearish market, just like this, giving you a bullish market.